Welcome to the B.F. Anderson Technical Report for January the 25th. Tom Lee, former chief financial strategist for J.P. Morgan, went out on his own, formed a firm called Fundstrat. Recently, he's in the media quite a bit, and recently in the media he said that he felt that the market was going to be in an uptrend for 11 years. Now, as we all know, I'm not real big on predictions, but he does have a very solid thesis that I think we need to be aware of. So let's get into it as to why I think there is a possibility that this is a bull market that will go on for an exceptionally long period of time. Now, this is not a prediction. It's just simply looking at common sense type of things to make that determination. So this first graph I have here is of the 30-year U.S. Treasury bond. Now you can see that for the last 20 years, bonds have been in an uptrend, meaning that as interest rates decline, the price of the bond goes up. So when you start to think about all the trillions of dollars that are in these 401k plans or in these retirement plans or these pension plans or whatever, most people seek immediate gratification. That is, we are biologically made that way. We want to do what is working at the time. So for the last 35 years, bonds have done basically better than stocks. So over time, you can see where there's this people are just going to be putting money in bond funds, annuities, what I call rocking chair type of investments, high dividend paying stocks and so forth and so on. So the $1 million question, and this is what Lee is trying to say, is that what happens if the bond market starts to go into a bear market and people seeking immediate gratification will start to move their dollars away from bond funds and into stock funds. We're talking trillions of dollars. So the question is, are we going to see a return of the animal spirits, where money leaves the bond funds and migrates to the stock funds? Well, if we take, and the other thing that Lee is trying to get us to do as well in this commentary is we've got to start thinking long term here. I mean, if we just constantly let every single day determine our direction, it's like a dog chasing his tail. You just can't do it. So trend following is evidence-based investing. It's not a prediction. Bonds, as I've said in the prior slide, have been the most popular thing. And at the same time, during a very extended period, the S&P 500 has done nothing but go sideways, actually from around 1996 till 2014. So you've had this extended period of time. You've had two bear markets. People have left the stock market. There is a pent-up demand for stocks if they decide to switch. Now, I'm not saying it's going to be easy. Just in the most recent period, we had what I call a little mini bear market right here. You're going to have consolidation periods like here. You're going to have the crash of Asia. It's not going to be easy. But if you can get from point A to point B, that's what this is all about. Now, back to understanding where we are today with the bond market. When I have set up here a graph where I take the Standard & Poor's 500 and I'm comparing it to the 30-year Treasury bond price. When the line is going up, stocks are doing better. When the lines are going down, stocks are doing worse. So you can see here that since 1994, and all I've done here, just so you understand, I connect the lows. That's all I'm doing, connecting the lows, and I'm connecting the highs. No forced graph here, just simple common sense. So basically, when the line's going up, bullish for stocks. When the line's going down, bullish for bonds, and so forth. Well, as you can see, since 1994, we have been locked in a period of time where bonds have basically on a risk-adjusted basis, have done better than stocks. But along comes 2017, and we're seeing a dramatic breakout. This is a decisive breakout where stocks are all of a sudden doing better than bonds. And so what Lee is saying in his commentary is that this process of a 35-year bull market in bonds migrating in, let's say, maybe an 11-year bear market in bonds, where's the money going to go? Well, he thinks it's going to go into stocks, and so do I. Now, back to the value line geometric index. Again, I'm just connecting the highs and I'm connecting the lows. These lengthy periods of where the stock market, the average stock, which the value line geometric index measures the average stock, this is a very rare occurrence to be going sideways for this extended period of time. Now, I remember something like this before, which was back in the late 60s, all through the 70s, and into the early 80s. We had about a 16-year consolidation period. Then the Dow Jones Industrial Average broke 1,000 for the first time in 82, 83, and we were off to the races and in a major long-term bull market. So we've got to think long-term here. We've also had to learn how to survive. We've had to learn how to survive these bear markets here. And this has been very difficult. But I will say that the key to any future bear market will be trend following. Now let's get into the top five. Michael Kors, again. Now you have to realize here, this is a high-quality product. And what it's basically showing me is that the market is rewarding a company that delivers a product that people want. And so we're looking at another company called Canada Goose, which is very, very similar. Here's a biotech stock, just smoke up a chimney. The biotech stocks have been gotten real strong here lately. It's a very risky area, but I do think we should keep an eye on it. Now, Netflix, we all know Netflix. Look at this earnings gap, tremendous earnings gap. Company is doing real well. They're doing very well internationally. I'm finding with Netflix the big key to their arrangement is they are doing original programming, and in the next 12 to 14 months, they're going to be spending billions of dollars on new content, and they've got some barn burner deals. I mean, the House of Cards was the kind of where it all got started, where people started binge watching. So anyway, Netflix. Again, the stock is acting incredibly well. Here we have another pharmaceutical biotech, Sage Therapeutics. Again, you can see the big gap here, and the stock continues to stay in an uptrend. Now, here's a stock that we've taken a position in called YY. This is a social media software company in China. It's very interesting what they do. You know, the Chinese culture is very, very different from ours, and this company is definitely popular, like a Facebook would be popular. But all said and done, we've got to think long term. If you have any questions, give me a call. Thank you.